which leads to my next question that my audience wants to know is, what is the squeeze right now that's happening in what's the squeeze happening in the banking industry to protect? So the rules of money, as you know, the richest man in Babylon tells us, he who has the money makes the rules, right? The banks make the money, my lenders have the money, they make the rules, they tell me this is what a good deal looks like, the DSCR is this, I just got to play by the rules, right? I don't have the money, the bank has the money, creates the money. So what are you guys doing right now? We're seeing a squeeze. You and I talked about this yesterday a little bit. We're seeing a squeeze. So another report where we're back to credit is tightening right now. Lending criteria are tightening back to 2013 levels. What are you experiencing with that? I know you kind of have both hands because your company does private lending and also you have banking. So can you tell us your thoughts on that, on what's happening with lending criteria right now? And at what point do you think we'll kind of go back to normal? Because this is not normal. We're not normal right now.
Yeah, it's tough to predict when's normal coming back again, right? I mean, the unique thing about where we are is that, especially in the space that we play in, right, which is typically something housing related, is there's still a significant housing shortage, and we still need to solve for that, and we need to actually solve for it in the affordable housing, kind of field. So you're competing against that, where in 2008 you weren't, right? We had a surplus of housing, and so that kind of created a separate issue, and we've come full circle in terms of kind of what's happening. And we haven't started tightening the credit box yet. We have seen, if you look at some agency stuff and some others, right, that LTVs typically come down first, right? When I was talking about the reserve model that we run, and most of those reserve models are, what's your loan, what's the collateral securing that loan, and how secure are you that you'll get your money back? So, if I have a loan that I did at 80% versus 60%, if that loan goes into default, well, I still have 40% in equity now that I don't actually have to reserve and hold liquidity for as much. So that's why you typically see LTVs come down first. Is that one, you're projecting for our value is going to fall. I'm not sure that values are going to fall, but I certainly think they're going to plateau. And in certain markets, they'll always fall. But again, there's still a housing shortage, so they can only fall so much or flatten for so long because the demand is still high. But you'll see LTVs come down. You'll see FICOs go up, and you'll see DSCR, and again in our space, DSCR, DTI, depending on if you're consumer or commercial. That number will relatively stay, I think, the same. It might go up a little bit, but the hard part about that number going up is with rates also high, that number is even harder to achieve as it is. And so, a 1.25 DSCR, at a 4% rate where you were before, is at a 7% rate now. The nice thing is that there's an expectation that at some point in the next, year to 2 years, rates will start to come down a little bit again. So if you cash flow at a 7% rate and a 1.25 DSCR, when the rates come down, they'll refinance. The cash flow will be even stronger, right? So well. Yeah, so you'll do well. So you're kind of just you're kind of buying a little bit of time, so to speak, to bridge and get back to the more normal environment that you referenced.